Yeah.
Yeah, it's always good to test it.
And screen sharing now. Okay?
Yeah.
Sorry, can you hear me?
We go. Just. It's really very soft.
That's so odd. I can't understand it. It's like this machine I've used for ages on all of these. And I don't know why it's like buggering up for us. Okay. Ready?
You're going to do a countdown for us, and then so I can hit the record button at the right time.
Go. Hang on, I'll just make sure I'm recording already. Yes. Okay, cool. Go back. Why won't you go back? There we go. Broadcasting now. 5, 4, 3, 2, 1. Good evening and welcome. Oh, hello Terry, can you hear me?
I can hear you, Louise. How you going?
I'm great. Are you sure it's loud enough? I know you're worried that I might not be loud enough. That's not like you and me at all. But anyway, pray tell.
Okay, yeah, I can hear you. So please proceed.
Please proceed. Okay, terrific. So welcome everyone. It is wonderful to be here. And we are talking tonight with Terry Ryder and myself about finance, which has been a bit topical for us lately, hasn't it, Terry? We've been working away on that together, haven't we?
We have, and we've been going through all the agonies, the delays and the frustrations of being a mere human being, applying to the finance guides for a loan to do something in real estate. It's not getting any easier.
No, it's certainly not getting any easier, is it? But, you know, those of us who persist, we're going to win the day eventually. But anyway, you've just got to keep at it, don't you? But anyway, say hello. Some of our friends are here who've some existing clients and others. Please say hello. Hello, Leah, and a few other, David, Christy, Ben, thanks for popping on. Please feel free to say hello in the chat box.
And also, we should point out to people as we're going through the presentation, if they have any questions or comments, to write them in the chat box or the Q&A, and we can deal with them as we go through or at the end, towards the end of the broadcast.
Terrific. Great. Thank you for that. That's good. Okay. I'll put that on. Hi there. Thanks for saying hello, people. That's super. Okay. Well, tonight we're talking about finance and how to make yourself look, honestly, how to make yourself look sexy as an investor. And we're thinking, well, has anything really changed since last October when we discussed finance last, Terry, on a webinar? And so much has, really. And you'd say, well, is it better? Is it worse? Well, it's not getting that much easier, I can tell you that. But brokers are now doing nearly 60%, over 59% of loans for people. And the reason why people are going to mortgage brokers is because it is so very hard to wade through all the trauma that's out there in trying to get your finance approved, particularly when you're an investor. And it's so hard. You really need someone on your side who can navigate and see what some of the headwinds are before you actually get there. So thanks all for jumping on tonight. It's great you can be here, and we're hoping, for those of you who couldn't make it live, we will do our best to answer. Those of you who are here and have bothered to show up, thank you so much for giving up your time straight away. But please feel free to jump in. We will get to your questions as we can. So the truth is, although the topic was how to make yourself look sexy, the reality is the banks want you to be the cleanest vanilla presentation there is and to have zero sex appeal. So it felt like it was just the wrong headline, really. That topic was a bit of misleading because they want you to be this clean, nothing to show type of presentation on anything. And when I was going through Google, I found this guy, Meet Luke, Australia's Clean Living. And we want everyone to look like to the lenders as clean and sexy as Luke. There's a bit of an ask, isn't it? But we're going to take Luke on a journey too with us tonight to show how we can appeal to lenders and get that great presentation that everyone would want to look like this, wouldn't they? But the Royal Commission is the topic that everyone moans about, and the thing that has impacted people so much is the fear that is driving lenders. They are really, really traumatised and scared about making decisions, and they're really scared about making the wrong ones. And so the number of times they will come back to you without even really doing the work and go, oh, that's a decline. And I'll go, hang on. We're not going to decline that. We're going to go and see what we can do. We might not be able to do the, $1 million I asked for, but you might be able to do so much. So how about let's talk about that, can we? And you really have to interrupt that process because the lenders, their first instinct is to say no. So if you're feeling like you're a bit negative about the whole thing, don't be surprised. It's certainly not personal. It is all about them at the moment. And understand also that people working in banks are not there because they're adventurous, go-getting types. Just remember that the people who work in banks are there because that's the sort of person they are. So you need to go and get support from someone who might be a little bit more like you. So definitely look for a broker who might be a little more interested and adventurous and ready to support you in actually doing something that's a little bit more adventurous. Because if you're not a plain vanilla, then you need to maybe at least present that way to banks. But it's interesting, in light of the Royal Commission, I heard Alan Oster, who's the chief economist at NAB, say he found that the branches were actually too scared to approve loans now. Previously, the brokers had this problem where we would try and get a loan through and we couldn't, if we were doing the right thing, we couldn't make something work. It would not be a deal, and a bank would approve it, and we couldn't understand how they could because they were maybe fudging something through the system. Now we've got the opposite problem. They don't know how to actually do a proper deal. They don't know how to present it. They used to make things up. Now they can't, so they've now got to play by the same rules that we do, and they don't know how to deal with it. So it's really...
So Louise, is there any sign at all that there's some easing up with this? We saw a few weeks ago the CEO of ANZ Bank came out publicly and said, okay, we admit it, we overreacted to the Royal Commission, we realised that we've become too tough and we're going to have to start easing off. Is there any sign that they're actually doing that?
They are actually even asking us, what can we do to make it better for you? So I'm actually having those type of conversations with representatives now. In the last, they're coming out to us and saying, well, what are we going to do to make it better for you to make this work? And I thought actually the CEO of ANZ, what he had to say about reducing the assessment rate was a really sensible thing to say. We're not talking, you could actually make it dependent on people's loan to value ratio. So like, for example, Terry, I've got people who are good jobs, stable, but maybe single mums or dads because of divorce or other circumstances in life. And this is happening to more and more people as they're a bit younger. And they need to get a house. And they might have a payout from their previous home, so they've got maybe a great sized deposit. So they might have 50% of the deposit. But they can't qualify for a loan because the assessment rate is 7.25 or some nonsense. So we've got to try and see if we can get people into who are well credit worthy and able to pay, but they're paying a loan at 3.5%, but they're being tested at 7.25%, which is just insane. So we're hoping that might see a change for the future. But anyway, so I should just say hello to people who don't know me. I've been a mortgage broker from 2007. I've been in property since the 1980s, and I've been national winner of Mortgage Broker of the Year and numerous other awards and things. But I just love talking to people about finance because I love seeing people succeed. If they get their finance together, people often go on and become much more confident and successful in life in so many other ways. I find that people get confidence in their finance and they actually buy an investment property and get moving. They then go and they get more bullshit work. They get further up the tree at work. They ask their bosses for raises and all sorts of things as a result of getting that confidence. So that's what I want to see for you. It's a really good thing to be able to do. The other thing, I've got to give you the disclaimer. Of course, use your common sense. This is not about you. This is about everyone. But tonight, what I want to cover off are the 5 biggest issues facing investors that I'm seeing as a problem every single day as I'm in the trenches fighting for people getting a loan. And you might say, well, geez, Louise, a lot of this is just good common sense and why aren't everyone doing it? And they are not. And they're coming up so often that I just have to mention them. And I do feel that people might say, oh, well, how irritating. But really and truly, I hope you'll learn something from this and you'll understand at the end of tonight, you'll get something to take away that you can actually implement straight away and at least help you plan your next finance attack, because it's quite important. So the 5 issues, and of course why these investors might, if they behave like this, have no sex appeal for lenders. So the 5 things are non-disclosure, too much debt, loan shopping, not paying off loans, and the wrongs. And there's a whole lot of wrongs that I'm going to briefly rock through. I was hoping we would get this done I should talk for half an hour, but I always say that and I always tend to end up talking more. Heaven knows, Terry will tell you that I would.
I can't imagine why that would be, Louise, but...
I would love, we'll talk, but anyway, that's okay. And so any issues and any questions, please feel free to put your own questions into the chat bar. That's fine. So non-disclosure. One of the things I'm finding all the time, every single day, and most applications, is there's something that people haven't told me. And that's the crazy thing. And it's not even necessarily deliberate, but by God, please don't do it, because the lenders ring us up and they go, you have a non-disclosure on this file. And they know about it. And it makes you look like a liar. And that is the last thing you want to be. So help debts. Now, one thing about help debts, that people go, oh, well, I don't need to pay it because I'm under, the 43 grand or whatever threshold it is. And I'm not obliged to pay. Actually, you are obliged to pay. People find, and I've found this often lately, people who've had a help debt of $15,000. It's the education penalty that people pay. And a couple of years later, because they've been not earning a huge amount of income, they didn't think they had to pay anything off because it was no interest. But what actually happens is they are charging you interest. And next $21,000 and $22,000, then it's just raising up because you've never looked at it. So anyone who has a help debt out there, I want you to get onto the ATO website. Go to MyGov. I know that's a nightmare. It's a strain for anyone, but I want you to get on there, have a look, and check what your help debt is, and make sure you've got a record of it, and make sure it's going down. And even if you aren't earning a huge amount, can you just put a couple of $100 every year onto it and just start moving it the right way? Because just doing that little bit stops it growing exponentially out from you. Credit cards. The credit cards that are non-disclosed are incredible. Travel ones in the bottom of the drawer. People have, I haven't used that for 5 years. It just doesn't matter. Yes, it does, because it's coming up on your credit check. And where it mightn't have come up before, and you might not even remember having it, if it's still open, it will appear on your credit file and the lenders will know about it. So you need to be really clear about that. And all too often people are going, oh, look, we had one today. A young first home buyer had applied for some latitude finance for some furniture or something, but didn't proceed. But that's hit on his file, and now we've got to prove that he didn't proceed. It's a real pain in the bum because it's actually appeared on his file and it wasn't that long ago. So the warning in that is, if you're planning to go and buy a house or do a loan of something significant in the next 3 to 6 or 12 months, don't go applying for a wretched, you know, whatever, furniture loan or hi-fi or JB Hi-Fi or any of those little credits, because they actually detract from your presentation. That's making you look like, you know, you're not doing the right thing. Solar panel loans, teeth fixing loans, all these sort of things happen. Oh, children. People actually ask me to leave children off their application. And then the same people are actually claiming family benefits back from the government. The banks actually check your your savings accounts and your credit cards, and they trawl through and see what are you actually paying for. And then they add them up. Now, big no-nos are having online betting on your thing, even Tats Lotto, visits to Crown Casino. These are things that they just don't want to see on your savings and card statements. So it's a really, you've got to start thinking and planning your strategy before you go and get that loan. You want to clean all this sort of behaviour up. And so you can see exactly what's going on. We had them come back to us recently for this young first-time buyer young couple, and they said, oh, you haven't declared sufficient expenses. When we've gone through their accounts, they're actually spending more on this and this and this. They've actually itemised it. And I said, well, it wouldn't matter because everything you found, we're still under the HEM, the Henderson Poverty Index, which is the minimum base level that the banks will use. I said, so I knew we were under, and we could justify where the money where they were spending it, and they're very low spenders. There was no question we were covered. So I said, what are you fussing for? It's not as if they're spending more; they're spending less, you know. So, but you just got to watch about that. And yes, I would be wary about Tats tickets too. I mean, aside from the obvious, it's just such a waste of money throwing your money that way. Please be careful about. They just, I mean, it depends. I had someone say to me once that they couldn't get their budget into the black. Every week they overspent. And then I said, well, let's have a look at your accounts and let's go through it. And they're spending like $70 or $80 a week on Tats Lotto tickets. Hello, there is the issue. And that's all they were, you know, overspending, waiting for the big day.
So, Louise, can you see the chat panel in front of you there?
Yes, I can.
And you see the comment there from Liz Supple, that might be a point worth making now rather than later.
Oh, Leah suggested that, can you remind people their help debt? She's a fabulous accountant. Thanks for listening, Leah. Can you remind people their help debt only reduces once a year when they lodge their return, even though their employer withholds each pay? How right, indeed. Thank you. And that's why it comes out, if you actually get the statement from the ATO, you'll see it go lump sum of 10,000 or whatever you've paid in whatever period. So terrific. Thank you for that. Okay. Oh, and zip pay and afterpay. Please declare these if you're doing the wretched things and close them. And get a letter from these companies that say that activity is closed, because clients will go, oh yeah, but I'm paying it off. It's not really a loan. But in effect it is, and the banks consider it the sort of behaviour that shows that you're not responsible or managing your money. And that's the thing you've got to be looking for. Are you managing your money the right way to appear that vanilla, fabulous, you know, person that we're looking for, the Luke, you know? So on your credit file, since we've had the implementation of positive reporting, it means that all of these issues appear like this on your file. And you can see on this National Bank, just as an example, a credit card, and you can see here down the bottom all the R's and the O's and each month what's showing. And that is when the credit card limit was open, and then is it being paid off or used. And the N is not reported, but the O is there was no problem with it being paid. So if you are regularly late and late paying on these things, this will show as you being a late payer. And that's another thing to avoid, because banks don't want people who aren't managing or paying their debts off on time. That is, and people go, oh yeah, but I'm always just a day or so late, and I don't pay any much interest, and it's not really a problem. Well, actually, it can be a real problem. So be really careful about that and start paying on time. This is the description, so you can see it, how many days after the grace period, how late you are. You're actually counting and noting that. So be really careful, okay? And that's on all open credit that appears on your file. And, I thought I had, yes, go to mycreditfile.com.au to get a copy of your file. You get one free a year. It's really worthwhile to keep an eye on that and just see what might be going there. I mean, I had a young guy who was applying, and they came back to me and said, there's an undisclosed electricity account that hasn't been paid. It's under $500, so we're probably going to do the loan, but we want it sorted before we proceed. I said, that was strange, but the truth was someone had actually hacked and used his account and they'd used it at a property he'd never lived at, and they'd used his license, and he had to go to the police and report it as fraud. So it's quite important that you look after your credit file and really seriously look after it. And the slide before that was just on people keeping their accounts in the black. The number of times I get it, and it might be only overdrawn, just your savings account, and they just go into the negative because their pay's coming in the next day, and I just drew down and I didn't realise, all those sort of things. But if that's a regular occurrence, then those are the sort of things that lenders are looking for and going, you know what, I'm not so sure we want these people. And the really sharp and fabulous rates that are out there at the moment, like the 3.49 for an owner-occupier or a 3.69 for an investor, they're the lenders who are saying no to people with these sort of activities. They are saying no because they can choose who they want, and that's their option. All right, so understand that's what you're competing against. So if you're not that sort of person, maybe you need to look at that. Okay. So number 2, the second item, and we're cracking along, but I better talk a bit even faster. Too much debt. So lots of these little debts that people get into, as I said, the afterpay, the car loans, the $20,000 write-off that your accountant might rush you into going and saying, well, this is great. You get that instant write-off and it's really handy from a tax point of view. But if you don't need a car loan, maybe you shouldn't be buying the car. It's just like, debt for the sake of it is, and for a tax deduction for that sake of it is not ideal. Just manage that side of your money much better. Multiple credit cards. Try and avoid having, cards or short-term business loans or all those things that impact too hard on your credit. Now, there are some lenders who will, if you're self-employed, will not count your business debts. Say you've got whatever in business happening and you've got a net profit at the end of that, they won't count that against you on a personal level. But most lenders do. So they go, even though you've paid for it out of your business, they will actually count a car loan and other things against you personally as well. And they say, we count the interest charge and we add back the interest. But it never works out as well as if the business is actually paying for it and it's having it left in the business. So if you're self-employed, that's one thing you've got to really watch with some lenders. And lines of credit, they're just like, please, if they're open and not used or things are available, that's a real problem. Unapologetically live you within your means. It's easier said than done, but that's really what the message is. That's what the lenders are looking for, and they want to make sure that you actually have money left at the end of each month. And I just love this slide from Jeff Bezos from Amazon. Look at him in his little Amazon office. So cute. Now he's worth so many billions. But anyway. Loan shopping. So there's times when you should go loan shopping and there's times when not to. So one of the problems is people are going, look, there's a lender with an even sharper rate, and I'll get another $2,000 rebate for doing my loan again. And then the next time they do it, they go, I only did that 12 months ago and I'll do it again. And I'll jump into another loan, and then they get it automatically declined. And they go, well, why is that? And it's all about rating back to your credit file and how many hits you've had on it, and the lenders wanting that clean, fabulous looking person. So I would advise you not to go every second year. But if within 2 years. But if you've not had your loan assessed within 2 years, but often longer. And I had a client today tell me, he said, we had arranged his refinance and he had to ring up this certain lender and ask for his discharge form. That's their protocol and he said, you're only making me ring up and get this discharge form from you so you can try and talk me into staying. He said, all the times I rang you and complained and said, can you do something to help me? You never wanted to help me. He said, and that's why I've moved. So it's too late. But it's, it's really frustrating for people. So with the brokers, we try so hard to keep up and check with people's rates and then check the lenders and try and get them reduced automatically for them. But sometimes you do have to move. I just warn you, if you're dealing with a broker, they get clawed back on their loans, any loan written within 2 years, if you change your loan within that 2-year period. So, and I don't know how you would feel about working today and then 2 years later someone said, oh, I no longer like the work you did 2 years ago. I'm now taking back whatever money you earned from that. And that's what happens. So if brokers are a bit shitty with you because of this, just be a little wary on it and maybe ask that broker to help you, because it's really unfair that people should be penalised for trying to do the right thing. And so brokers, obviously it's in their interest to make clients happy and make sure they stay connected and do the right thing. And that's why more people are going to brokers. Just briefly, I wanted to review servicing a loan. The PAYG, probation is fine. A lot of people are concerned about probation. A lot of lenders, if the LVR, the loan to value ratio, is not too high, if it's heading up to the 95, 98%, then that's a different matter. Then it can be a little problematic. Now, as you would have seen, the government announced recently, the government of today, and then the opposition said they'd back it, said that they would be the guarantor for first-home buyers trying to get into a home with less than a 20% deposit. So that made me think, well, the lending insurers that are out there at the moment must be feeling like, well, their whole business is about to get wiped off by these governments interfering with their business. But secondly, if you're actually applying for a loan at the moment or in the next little while, and you want to have use lender's mortgage insurance, I would suggest they'd be saying yes to a lot of things before these policies get implemented. So I would be making hay while the sun shines, because I think it's quite a good time to be in that space. Bonuses I've talked about must be 2 years on payment summaries and regular allowances we can use. Oh, hi Christy, sorry, you've got a question. Does your current home equity play a factor? Yes, certainly, but it's a different thing. There's two things and ways to consider, and one is your servicing, which is what I'm talking about now, and the other one is your equity. And lenders need to assess both. So you can't just rely on your equity if your servicing's no good, and you can't just rely on your servicing if you haven't got much equity. But you'd much prefer to be in a stronger servicing position and have less equity, because you can generally manage to get a loan. But just having equity and no servicing won't help you, okay? I'll talk a little bit more about that. Just with a lot of people say to me, I'm self-employed and that's why I can't, I won't get a loan. I go, well, actually, that's not true. The truth of the matter is, if you're paying tax and earning good income, like Mr. Ryder on his financials, no problem at all, you can get a loan, as long as you're paying tax and doing the right thing and earning plenty of money. But if you're actually not declaring any income, not paying any tax, and still expecting to borrow, then you might have a problem. So you need to be really sensible about it. And if you're just taking your cash and putting it to the Bank of Sealy, Posturepedic, then you might need to be a little more prudent and actually start banking it, okay? I've got a question there from Dom. How many months back do most lenders go to check on your financial affairs? 3 months is usually fine. So that's not very long, 3 months. But on existing loans and sometimes on credit cards, they will go back 6 months. But generally on your savings account, it's only 3 months that they will check. Okay.
So Louise, so just to clarify, because I think there's an important point to be made there, when they're particularly scrutinising people's regular spending at the moment, I think, aren't they? And you're saying that they'll just go back through 3 months of like bank statements to check on what your spending patterns are. Doesn't that open up an opportunity if you know you're going to be looking to buy something? You've got 3 months in which to really clean up your act, cut out your frivolous spending, just really have essential spending only, and just present a really good, clean 3 months of limited spending. And it's actually not a hard ask if you're sufficiently well organised and planned to know that, you know, three months hence you're going to be applying for something.
Yeah, I agree. I think that's absolutely and it also shows, even if that's not your usual behaviour, it shows you can do it. And often 3 months is enough to make that new habit quite a good way to go. And what I find is I don't mind that people presenting even temporarily like this, because most people are going to pay their mortgage first. They're not going to go, oh, good, now I've got a house, I'm going to go rush off and spend all my money on an overseas trip and blah, blah, blah. That's not what happens at all. People get a mortgage and most of them are dedicated to paying at least the minimum that's required to keep it going and keep a roof over their head. That's the focus, you know. They're not out there frivolously spending just, you know, because they can. It's crazy. No one wants that sort of grief in their life. So what I found is, and Genworth and QBE, the big mortgage insurers, have done a huge amount of research on this because that's their game. They're the ones who are insuring the people who aren't with the full deposit. So they are really careful about who they're lending to, and they're checking all these things in the background. They have vast data on all of us. They know where you live and what you're doing. So, and how people behave in certain postcodes and what they do. So you just need to be that person and present the right way to get it through. You know, a lot of the banks have their own approval, you know, ability now, so that helps, but it's still insured anyway. Yes, I agree with you. I don't think it's a bad thing, you know, having the you know, presentation for that period. The rent, look, just what I'd say about rent, how you work it out to maximise it is the rent per week, divide by 7 to get a daily rate, and then multiply by 300. And yeah, show here, Christy. My favourite's The Good Place. Actually, that's the show. I don't know who's watched The Good Place. I love that. It's the where she can't say fork. She has to say fork all the time, or shirt. Anyway, but to get your rent, divide by 7, multiplied by 365 days equals the maximum rent you can have. But here's an interesting thing. One of the lenders was telling me today that they are looking at taxing the renting income. Most lenders already shave it. They shave it by 20%. Some shave it by 25 across all residential properties. Some actually shave the rent and then add back your expenses as an extra, for God's sake. And then I've got one lender said they'll only count 70% in WA, 75% across the rest of the country. WA is particularly singled out for only 70% of rent is accepted. I don't know what the problem is. I presume they think there's more issues there. And for non-standard properties like commercial, rural, residential or serviced apartments, they'll only count 60% of the gross rent. So, and restrictions obviously then apply to high density places and other things. So these are the sort of rules you need to know when you're actually going for a loan. You need to be aware of that before you go to a certain lender, because that can damage you quite badly when you don't realise that they're a lender who only accepts 70% of rent from that property, where someone else accepts more.
Louise, what chances any mere mortal out there got of knowing all that stuff? I know it's kind of a leading question. It means we all need mortgage brokers who, and also I think it's true, isn't it, that the landscape is changing almost daily in terms of.
Yeah, we have to work really hard to keep up, and I don't know how any individual could do it. Yeah, it's very tricky. as I've said, Airbnb, and renting rooms out in your home. If you're not declaring it on your tax return, for God's sake, then no lender's going to accept it. So you have to get in there and fess up and pay your tax, and then we can accept it. But if you're not doing that, well, good luck. Anyway, and you can see the other things. Credit cards, for every, we lose $150 off your servicing each month for every $5,000 credit card. So usually if it's a credit card in your own name, we lose, it comes off your monthly income servicing. They take $150 off for every, that's some lenders, some are more, some are less, but that's just an average, okay? Just so you've got an understanding of what sort of impact. And if you're really close to the bone, well, shutting down a credit card to $1,000 will reduce it, give me another $120 a week, so it's really, that's what we might be asking you to do to get a loan approved, okay?
Louise, can I just clarify that? So when they're working out how much you can afford to service, for every credit card you've got with a $5,000 limit, they knock $150 per month off that. So if you've got 3 credit cards like that, that's a $450. They'll reduce your servicing capacity.
Yes, that's exactly right.
Okay.
So
it's a question of how many credit cards do you really need? Do you have surplus that you can get rid of?
Well, the joy of lately is, since the Barefoot Investor, I'm getting heaps of people saying, oh, Louise, we don't have any credit cards anymore. And that's great. And there used to be this furphy around that you needed a credit card to get a loan to prove your credit worthiness. But that's all gone by the by. Now, if you've got a mobile phone or you've moved into any rental property, you've already got a credit file. They're already checking you, because the internet now has got all these ways of tracking what you're doing and are you paying your bills on time. So they can see. Yes, $1,000 credit card does count. Everything counts. But just note how much it counts. So sometimes we've been asked to remove a $1,000 card. Christ almighty, you think, really, 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 it makes it really hard, but that's what happens, okay? So number 4, we're getting there, not paying off your loans. This is a big problem, because I had a poll actually, and I wanted to ask you if I can do this. Oh yes, I'll put this up there. Let's see. Have I done that right? There it is. Can I ask you these questions? Do you have any interest-only investment loans, and would you prefer them? And can anyone now answer the poll? And it'll be interesting to see, because the biggest problems we're finding is the offers that some of the lenders are giving are for only principal and interest repayments. So do you have those interest-only investment loans, and would you prefer them? Oh, it's 50-50. That's interesting at the moment. Yes, but there are quite a lot of them out there. Keep voting if anyone else is there. Have a go. That would be great. So we've got that the majority of people, 71% so far, have, or over, more, it's increasing as we keep going, have interest-only investment loans. And that's normal. That's what you've been advised by your accountants, and it seems quite sensible. If you've got owner-occupied debt, you want to pay that debt off first. And that's, more than sensible. And the idea is that the investment property will eventually be sold, or, that'll come after we've paid off our home. But now because of the APRA stepping in and putting a limit on interest-only loans, which all the banks kept well under, they're all fine, there's no issue now, they still want to penalise people. But a couple of lenders are out and offering these insanely good rates. And it's interesting, it's true, people do get, it's 50-50 on whether you'd still prefer an interest-only loan. But the reality is, so we've just, that's the result. Interesting. So what we're seeing, though, is that people will wait 5 years or 10 years and go, look, I don't want to pay that off. And then now their lenders have come back to them because they're with the same bank, and the banks go, well, you can no longer afford that loan. You go, well, how is that? I've been paying it and I'm happily doing it and I'm being good, from now on. But what happens is, if you're with the same institution, they now have to shorten the period of time which you can pay that whole loan off. So usually when you apply for a loan, we will apply for a loan over 30 years repayment. But say you've had 5 or 10 years interest only, then they've reduced the amount of time you have to pay that loan down to 20 years or even 15 for some. And so the repayment has gone up enormously. The actual repayment expected is really high now. And that's what they're testing you on for your repayment. And they're testing you on that repayment. It's over a very short time, and then testing you not at even if the repayment is 4%, but at 7.25%. So this is why people aren't servicing existing loans with their current lenders. I don't know if that's made complete sense to you, but understand they're reducing the term that you have to pay. So if you have had an interest-only loan with the one lender for a couple of years, you really might be tempted to go and find someone else. And that's why go and get a broker to do a proper assessment for you so that you can see whether you can qualify for another 30 years and get at least another 5, maybe 10 years interest only somewhere else. And do pay your home off first. But there's no real harm, because sometimes paying principal and interest can be that much cheaper than the interest-only loans, because the interest rates are so high on them, that it's the same repayment, but you're actually paying principal. So actually do that test. Is my repayment, if I reduce it, because I've been getting principal and interest investment loans, some of them even interest-only, but investment loans down at 3.69, which is really cheap. And some were fixed for 3 years. I could get 3.89, 3.79. So it's a very cheap rate for a principal and interest repayment, depending on your circumstances. What else was I going to say? Oh, I can't remember now. I'll keep going. It'll come back to me. But anyway, we better push on. Next. The wrongs. So let's go through quickly. The wrong structure, wrong title, wrong size, wrong postcode. So people often do this too late. They come to me after they've bought one of these wrongs, and it makes it really hard. Don't come if you don't know which name it should be in the property. If you and your partner want to buy it, and then you go, after the loan is approved and docs are issued, you then go, oh, actually, we want it in someone else's name. It can cause real problems. It can not only cause real problems just from a lending point of view, because they might say no, but in Queensland, sometimes there's been a problem with actually the banks, the government saying you're actually selling that now from 2 of you to 1 of you, so you're going to pay stamp duty again. And that has actually happened to people. So be very wary about changing names after you've signed the contract. Get it right the first time. If you're buying a company name, no capital gain deduction, but they're reducing, the Labor are threatening to reduce the capital gain deduction anyway. And you might buy in a trust for asset protection. Trusts are not much problem. People, banks, lenders are very familiar with that, and they're quite prepared to lend. And the rates might not be as good. That's the only problem. So often you can't get an offset account against a trust loan, but because it's an entity rather than your personal, so that's why. But other than that, so you need to define that structure before you go and buy, okay? Wrong title. Company title, I'm just going to go through these different types of title, but Torrens title is the standard. But company title is an older style of title, and a property does not have a plan of subdivision, but comprises a number of units. And the problem with company title is that all the owners on that in that company can actually decide who can come in and go out of that company. And that's why lenders don't like them. So there's only a few lenders who are quite happy with company title. There's a lot who won't. And this is why these properties, these apartments, are often sold at auction, so you don't have any cause to come back at them. and you'll do your deposit. If you can't, then get a lender to lend on you. So be very, very wary when checking contracts prior to buying, particularly at auction, because these difficult properties come up and then you'll find it much harder to get a loan. And if your circumstances are not so clean, then you've got add this into the equation, and you're going to have an even bigger problem getting a loan, and then you could be in real strife, and you just don't need this sort of stress in your life. If you're going to go and buy one of these properties, go and get the approval from the bank before, at least run it past them and make sure they're happy with it, okay? Because and sometimes they'll go, look, actually the lender might say, well, I already own, they already, have half the mortgages in that property. We might not want to give you any more. And that can be an actual building specific. So it's really, really important you check this out before you go and purchase, okay? Don't buy at auction on these ones. Stratum title, the same. It predates modern strata title subdivisions, and each property is subdivided into lots, blah, blah, blah. Now, the service company owns and manages the common property. Now, the problem with these is, and you've got to check the constitutions of them for any restrictions, because they can restrict who you can lend to, who can own it, and all sorts of things. And that's when a bank will go, no, we don't lend to people who are living in that property. So you really need to get a lawyer, and I mean a lawyer, to check it out carefully for you. The wrong size. The other thing, some lenders, look, it's still 40 square metres is basically the smallest people want to go. There are a few lenders who will go to 35 and even 28. You've got to have a pretty good reason, and you want to have your approval in place before you go there. Don't buy one of these at auction. Make it easier on yourself, and at least get it measured before. The other thing with the 40 square metre, the agent tells you it's 40 squares, but that might include the balcony or the car park or whatever. And some lenders might not accept those elements. So you need to be really careful about that. And again, take that property to a lender and say, will you lend against it? And they will often check it for you and let you know. Wrong postcode. Lenders keep this information in a mystery box, it seems. You have to actually note. Sometimes they change. Like I had even Commonwealth Bank, who used to be just say, give us a postcode, we don't care. Pardon me. But now even they have postcodes where they say, no, we're not lending at 90% there, we'll only lend at 80% loan to value ratio. So you want to be very prudent about what sort of thing you're buying in that area, and make sure that your lender's quite happy with that. Some of the smaller lenders you might be with, because they're a bit more obliging on lots of things, and will go to 90 and 95% for an investment loan, will actually say, oh, sorry, we're not lending because it's a bit far out, or it's a bit country for us, or stuff, or we don't lend in that postcode. So all of those type of things have to be checked off before you rush out to buy.
Louise, I was doing some work late last year with one of the new lenders that was entering the market, and basically they wanted help with establishing a system whereby they had colour-coded every postcode in the country, and it might be postcodes that were green, they would lend 80%, postcodes that were orange, they would lend but only 70%, and postcodes that were red, they wouldn't lend at all. Wow. So basically, and there was an awful lot of red ones and there was quite a few orange ones. So it was pretty stringent. And I'm not quite sure how they were arriving at their ratings of postcodes, but yeah.
So when they consulted you, were they looking for guidance on which you thought would grow faster or not for them?
Well, they were looking for guidance on how they would establish which colour they're going to apply to which postcodes. They already had sort of like a tentative system set up, but they wanted a little bit more definitive information. But
wow, it's so
yeah.
Scary. Gosh, so we need to know what you told them. Which report's that going to be? Come on.
I think, anything that sort of is an area reliant on the resources sector, for example, that was in their red basket, for example. Areas that had in their recent past serious problems with oversupply, high vacancies, they might have been in the orange or the red. So, and
Okay, so yeah, well, that's probably prudent for our investors anyway, because you're looking at your vacancy rates and you should know all that before you go by there. Yeah, how do we obtain that information? Really good question, Christy. Actually, you have to ask a broker to assess. It isn't that easy to get, to be fair. And I actually have to often ring a bank and lender and ask them specifically, will you lend to these people on this property?
Because they don't all have the same attitudes to the same postcodes, of course. Some will say yes to certain postcodes.
Right. Yeah, they're all different. Some will say, you think, oh, well, everyone will agree to that one. Like Richmond in Melbourne, you'd think, well, surely to God, everyone's going to agree Richmond's fine. But actually, because of the density there and all those apartments that are being built, a lot of them won't let you borrow there at 85%, which is, you think, what the heck?
It's just another example of why I think everybody is in the lending market or the borrowing market needs access to mortgage brokers, which sort of takes us back to the findings of Kenneth Hayne and how ridiculous it was for him, so out of touch with the reality of people out there in the market, to suggest that we no longer have a system of mortgage brokers. I mean, I don't know how people find their way through the maze that, the different issues and the fact that every lender has got different attitudes to all these things. How can anybody out there as a consumer find their way through this maze without the help of a professional like a mortgage broker?
They often wonder why they've been rejected and they don't know. And that's the other problem. At least with a broker should be able to tell you, look, we couldn't do so well here, but we might be able to do it here. And that's what you need. You need someone in your square. But I've got something for you, Terry, later to show you about that. So, and this one's just for you. What is if you're the wrong age? And I feel this too, because that's my problem. Why
is that especially for me, Louise?
Terry, and for me, being of a certain vintage, the banks are really, actually anyone over the age of 45, just like us, the banks want to know. In fact, some of them even at 40, they're asking people, what's your exit strategy on this wretched property? For God's sake, what's your payback strategy? At 40, you're barely, worried about, that's hardly your retirement plan. But we actually have to account for that, and you have to say, well, we're going to amortize and pay down this much debt, and we have to work it out and give them a graph, and then we have to say, well, we've paid back this much of their home and we're going to downsize, and we've got to show them excerpts from realestate.com to show that this is a property they could downsize to if they were in this area still in 20 years. They could, whatever. This is the sort of drama that mortgage brokers are going to in the background on your behalf that you might not know about. But one of the things I want you to be very wary about is don't say you're going to use your super to pay back a property, because they certainly don't want to hear that, okay? So using your super to pay off property is not the right answer, just so you know, okay? So it's really important, get your ducks in a row. But here's the thing, if you want to get your ducks in a row, you must first get your head above the water. So we want to see that you're very positive about all your finances. That means including little things like having the wrong address on bank statements, little things like having the right address on your driver's license, keeping your passport up to date so that when you give ID, you've got, plenty, 100 points easily. So I just want you to be very careful about all those little admin things. They're part of your presentation, and you need to have that clean. So let's just review our 5 biggest success actions for investors. The first one is, I want to say to you, is disclose everything, okay? I can't stress that enough. They'll know about it, and you don't want them coming back and saying, geez, you lied to me. Reduce all your discretionary debts. And on that, Vicky's asked a question about the difference between having 2 credit cards at $4,000 and $5,000 each, or 1 credit card at 10. Absolutely none. It's the limit, total limit. It doesn't matter whether you have 1 or 10 at 1. Although the problem with having multiples is it's more hits on your credit file. If you've actually got 1, it's 1. If you've got multiples, then there's multiple hits. And the problem is, if you've got 5 hits within 12 months, then that, in some lenders' eyes, is an automatic fail. And even if you're perfectly wonderful with credit, you just might have applied for different things over the course of that 12 months or 2 years, they will give you an automatic fail and you will not know why. and that's all it will be. It will just be some system scoring in the background that has caused you to fail. So be very wary of that. So the less the better is actually the answer, Vicky, but it really shouldn't matter, but it is the limit that plays the problem. So reduce all your discretionary debts. Apply only biannually to move. Certainly, at least every year or two, you should review your interest rates, and then but do a major review every 2 years for sure, but don't move every year. It looks bad on your file. Pay off your loans. I do think it's worth actually moving to principal and interest if you can, because the rates are so great now. And get the wrongs right, get the right structure, the right size of apartment, the right postcode, all that sort of stuff in a row, the right title that you're buying, so that you know what you're doing before you go and apply, okay? And one final thing, my challenge to you is to keep yourself clean so you're looking good. And I'm sure that, I hope that there was some things for you, but I just want to show you my video, because this is what Kenneth Haynes should have seen before he brought out his Royal Commission. But I had, this is a thing called Cameo, which you can get someone to promote and support you. So when I was feeling a bit low, I thought, this guy, Jesus, I called on him to help me. So I'm just going to play this for you. Hang on just a minute.
You know I'm Jesus and walk on water. But when it comes to getting a loan, Louise Lucas is the one who rises above all. I cannot recommend her enough. So when you're needing that guiding light in finance, see Louise at the Property Education Company.
I think he's hilarious. Whenever I need a cheer up, I just put on Jesus. I think he's a screen, but anyway. So there you go. That's my talk for tonight. Oh, we've got 5 minutes spare. See, I knew I'd finish early. No. Any other questions that anyone would like to ask? I think we've done it as we went, Terry. I think we've nearly cracked it through, have we?
Well, you did deal with a lot of the questions as they popped up, which is a good way to do it, because they're relevant to the topic that you're talking about at that particular moment.
Right. Well, terrific. If anyone wants to comment.
Personally, I could use a little bit more clarification about what you mean about loan shopping, and it's suggesting that some people are sort of constantly looking to refinance their loans, to constantly get the best deal, the best deal, the best deal. Is that the situation you're referring to?
Yeah, I do. I find it really bizarre that people do this, because it's actually really, it's not only is it a painful process, we tend not to put people through it unless we have to, because it's really hard work. And secondly, it's quite expensive. There's still all the government charges that have to go through automatic, even if you get rebates and things. So it can be expensive.
And you're suggesting it also looks bad on their credit file. They're constantly chopping and changing.
And they've got to be good reasons for it. And if you've shown that you've jumped from one lender to another, then they can see all that and they go, well, what were you doing? You know, we don't want you. And if that's what your history was, and now your history's going to be there for years and years, do you really want that shown? You know, so be careful. Someone asked a question about the age limit. No, people will let you borrow right up to 70, depending on the institution. It just depends on the term of the loan they will give you after, Vicky. Sometimes they'll reduce the amount of years you get to pay it back, and that can make a loan really expensive, because if your repayments then become really high, if you were paying the same loan, and it's an investment, you don't want to pay it necessarily that quick. You might want to just leave it there for 10 years and then sell it. You might not have any intention of paying it back, and it wouldn't worry you at all. Oh, so, you know, that's up to you. Terry, someone's asked about best suburbs for house flipping. Oh, and please, if you're house flipping, don't go to a broker. We only get paid if you stay in a loan. That is one of the problems. And if you want to flip, go to the bank, you know. But don't tell them, because they won't like it either. And that will be a problem for you. But anyway, you go for it, Terry. Do you what's the best suburb for house flipping now?
Look, I'm not even sure exactly what they mean in terms of a strategy. What exactly are they driving at there, Louise?
Oh, probably for a quick renovate and flip. But I mean, honestly, in Australia, there are so many, it depends on the areas and what you're doing. You know, there's so many places you can go and do these things. But
So if we're looking for areas that are got rapid...
It doesn't work that well.
I just don't think it's a smart strategy. But if we're talking about suburbs where
I agree.
Currently the price growth is rapid, and you know, you can buy something and get in and out in a year and make good growth. Not a strategy that I'd ever use, but most of those sorts of places where prices are rising strongly at the moment are in regional Australia. There's not many of them left in any of the capital cities for rapid growth, but that's starting to the rate of growth is starting to reduce now.
Okay.
Most of them are actually in regional Victoria. That's where I think that's the strongest market in Australia right now. We've still seeing the suburbs of Geelong the last 12 months. Many of them have had 20% plus, but I think that's past its peak. So you're really taking a punt on where's the next place that's going to show that sort of rapid short-term growth. Ballarat's looking pretty good for that at the moment. But some locations in regional New South Wales, the Sunshine Coast in Queensland, which is where I'm sitting right now as part of that region, the upper end of that market is showing really big growth. Top end suburbs, 30-40% in the last 12 months.
Right.
So as a general rule, if you're looking for rapid short-term growth, you should be looking regional rather than capital city at the moment.
Okay, and that's maybe not for flipping, that's the thing. Yeah. Okay. Oh, and another question was, when do you need to consider when you move an investment property from interest only to principal and interest? Look, if you could move it now anytime, and get a much better rate. That's the generally speaking, although there still are some great rates out there, but say some of the lenders that are offering those interest only rates for really low interest rates, like in the 3.69s and that, they want you to have, the servicing has to be terrific. You need like an extra $500 a month cash free sitting there in your servicing without any trouble. And that's what they're looking for. So if you're not getting that, then I'd be wary. If you're, fairly tight on your servicing and you're not sure, you've got a huge amount of wiggle room, and that's why you want that low rate interest only loan, then you're probably not going to get it. They'll just decline you and they won't tell you why, and it'll be because they think you're too tight. Yeah. So, and Terry, someone else has asked about, what about buying owner occupied to upgrade to family home for a young family? I'm not quite sure what you're asking, but is this a good time to buy for owner occupied and upgrade? Oh, any place you'd suggest, Terry, because we're in Melbourne.
Okay. Well, I mean, I assume the question is about where can we buy as owner occupiers? Somewhere in the Melbourne area where there is growth happening at the moment. Not too many of them left.
No.
Up until recently, what we've seen is that the real top end of the Melbourne market has dropped a lot. The middle market has sort of dropped a little, holding its ground pretty well. And the outlying areas, the outer ring suburbs, the cheaper ones, have still been growing. But we've got to the point now, it's pretty clear from the figures, where that period has also run out. So we're not seeing the same uplift in the outer ring areas. Melton, for example, last year, many of the suburbs of Melton grew 20%, but that's gone now. It's rippled out beyond Melbourne. It's now happening in the regional areas of Victoria, and that's a possibility that more and more Melbourne people are actually considering as an option, not only as investors but as owner-occupier buyers, going outside the Melbourne metropolitan area, but still within commutable distance, perhaps. Mm-hmm. And that's why we're seeing such strong uplift in some of the regional areas of Melbourne, up as far as Ballarat and Bendigo, but many of the hill change type towns in between there and metropolitan Melbourne, and also out in the south. the southeast areas, Pakenham, Officer, out to Warragul and Druin, and even beyond there. So, but in terms of Melbourne, growth suburbs, there really aren't too many left in terms of prices. That particular horse is bolted for now.
Okay. Oh, right. Well, one thing I would say to people, though, if you're intending to upgrade at the moment, do it, because it's much better if you sell in the lower market and you'll get more bang for your buck, and you'll end up with a lower loan for a bigger property. So, you know, you're paying less overall. People say, oh, I should wait till the market improves, but I think that's an actual fallacy.
Well, if you're buying and selling in the same market, it really doesn't matter too much what the market's doing, as long as it's not changing really rapidly, because you've sort of got to sell first and then buy, or you might buy first and then sell, which is often a mistake. And so if the market's moving rapidly, you've got to be very careful about the order in which you do things, but otherwise buying and selling in the same market, you're sort of winning on one and losing a little bit on the other, so it really becomes a little bit irrelevant.
Yes, but the bonus of doing it now is because prices are down a bit, then you've got less of a loan, hopefully, on the newer, bigger property. So upgrading, it's the market to upgrade. That's what you should be doing. But anyway,
Yeah.
There you go. Well, thanks all for coming. We really like talking to you. I hope you learnt something and enjoyed tonight. And we'll send around the webinar recording, I think, Terry. And otherwise, lovely to chat to you. Thanks for coming, and I'll speak to you soon.
Okay, thanks, Louise.
Thanks all. Bye.